We do have Alex Provence. She's our Kona branch manager, and I'm Kurt Nielsen. I've had a mortgage company in Hawaii for going. This is our 23rd year we're heading into. It's and it's been a blast. I've had offices on every island, and um, the mortgage business has gotten a little bit more remote lately. Ever since the pandemic. So we do mostly everything by by email and Zoom and just kind of remote. I do have processing staff that they've been with me for I don't know 22 years, and they start at 4 a.m. And the reason for that, a lot of our transactions um, are with lenders who are as far away as Eastern time. So in order to cover more business hours, we open at 4 o'clock. Um, Alex doesn't, but I do, and the processing staff does. So we're
We're on
early starters. And
well, he knows
so
on
when
me,
we
but
when
we don't have a video.
I think somebody's talking. I didn't quite hear it, but
I don't think Anthony's talking to us.
okay. If you have any questions, go ahead and ask them as we go along. I think it's a little easier as your questions come up. We have a slide up there that you're looking at. It'd be a little easier to answer your questions. Otherwise, you can pop them into the chat. Alex will interrupt me with any questions that are pertinent. And this program today is reverse mortgages, using your home equity to improve your retirement. That's really what it's all about, is utilizing the equity in your home and living off that equity in your home while you still live in your home. So, that's what a reverse mortgage is for. This is going to be really basic. We're not going to get into, there's a lot of more complicated features of eMortgage. Of reverse mortgages. We have jumbo reverse mortgages. You can go to $4 million on a reverse mortgage. So, but we're going to stick with the FHA program, which is called a HECM mortgage. It'll give you the gist of how reverse mortgages work. But for a lot of people in Hawaii, you might have to look at a jumbo reverse mortgage. So we're not going to get a whole lot into that today, but they are available. So, okay, I think we're ready to go. So today we're going to go over what a reverse mortgage really is, the different uses of a reverse mortgage. I think you're going to be pretty amazed at some of the things that you can do with a reverse mortgage. And I'll go through a few scenarios so you have an understanding of what people are doing with reverse mortgages, kind of setting some expectations. We'll go over some of the misconceptions. A lot of people have a negative view of reverse mortgages, but it's a government program. It's insured by FHA, and you're protected. That we're going to go through some of the borrower protections, some of the benefits to the borrower, and how to be eligible, both you and the property. There are certain properties that are not eligible for a reverse mortgage. And at some point, the mortgage has to be repaid, and we're going to talk about how that happens. And then we'll just go through some of the cost of a reverse mortgage. They are more expensive than regular mortgage in getting them set up because it is a complicated mortgage, and so there are some costs associated. And then we're just going to look at your retirement and how a reverse mortgage can fit into your retirement. Okay, so what is a reverse mortgage? So we call it a HECM, a home equity conversion mortgage. It was authorized by Congress in 1988. So, we've had 37 years of it. It is insured by the FHA, and the FHA provides quite a few protections so that senior citizens are not taken advantage of. So there's a lot that goes into getting a reverse mortgage, education, and things like that. So we want to make sure that a senior citizen is not, trapped into a mortgage that they didn't want. So the purpose is to allow senior citizens of 62 and a half. Now, on the jumbo mortgages, you get a jumbo reverse mortgage at a younger age, but for the HECM it's 62, and you can tap into your home equity without any real income qualifications. I'm going to give that as a qualifier, but you don't have to prove income to get a reverse mortgage. And that's the big difference. A lot of seniors feel that they're kind of trapped into their home because if they sold their existing home, they couldn't get a new mortgage because they don't have any, real income anymore. They might have retirement savings and things, but we're going to show you how all that works. There is no monthly mortgage payment required. You can make payments. But instead of making a payment, the mortgage actually could pay you. And now, obviously, if you're not making payments, the principal balance will increase monthly based on the interest rate, and it just begins to accrue. And that's how you use your equity to cover the mortgage. You still must pay property tax, property insurance, HOA dues, and you must maintain the property in a livable condition. Those are your requirements. If you violate any of those requirements, if you let the property taxes go past due, you don't pay your property insurance, the loan could be called and be accelerated, and you'd be required to pay it off. So it's not like you don't have any expenses. You still have to maintain the property and the insurance. You still own your home just like any other mortgage. So the lender doesn't get your title. You retain title, and anything happens to you, your heirs would inherit the title to that property. You can never be asked to leave the home as long as you're living in it and you're meeting the requirements of paying your taxes, insurance, HOA dues, and maintaining the property. So you can never ask to leave the home, even if the mortgage is more than the value of the home. So if we went through a significant downturn in the real estate market, you're protected. There's an insurance policy that protects the lender. So no harm, no foul, even if the value of the property is not as big as the mortgage itself. Repayment of the loan is made when the last borrower sells, moves out, or passes. So if it's a couple, in order for the loan to come due, both of the couple would have to either sell, move out, or pass. So, okay. So the loan amount on a reverse mortgage depends on the value of the home, the age of the borrower, and current interest rates. So the higher the value of the home, the more money you get. The older you are, the more money you get. The lower the interest rates, the more you get. So we are expecting a reduction in interest rates, maybe a little bit, maybe a lot. Who knows what happens with the Trump administration. But there are situations where, let's say you have a reverse mortgage for 5 years and interest rates go way, way down. You could refinance a reverse mortgage and get even more money. So again, it is a factor of those three things. There is no time limit on a reverse mortgage. It's not a 30-year mortgage. It's not a 40-year mortgage. It's not a 50-year mortgage. It is as long as you live in the home, no matter how long that is. So, theoretically, if you got a reverse mortgage at 62 and you live past 100, it could be a 40-plus year mortgage. And again, it doesn't matter how much you end up owing. If you owe more than the home is worth, so be it. This is a mortgage that has no recourse back to you. So if the home is less than what the mortgage balance is, then the lender just doesn't get paid the full balance. But then they look to the insurance policy, and the insurance policy will cover the deficit. your heirs, your estate. You could own other real estate, and you never have to, your estate never has to cough up the difference. So when the last surviving borrower sells, moves out, or passes, the loan comes due. You have to stay in the home at least 6 months a year. If you don't, that violates the terms of the loan. So if the borrower passes, the borrower's heirs can sell the home and pay off the reverse mortgage, and then they keep any proceeds that are in excess of the payoff. So if the home is worth $1 million and the current loan balance is $700,000, when they sell the home, the heirs get the extra $300,000. Or the heirs can refinance the property and keep the property, but something has to happen with the mortgage if the borrower sells, moves out, or passes. You know, that loan then comes due. It's no longer an active loan, and you have 6 months to complete that, and you can ask for another 6 months if you don't get it completed, like a refinance or the sale of the property. So they're pretty lenient, and they're not there trying to hurt the borrower. This is all based on trying to help a retiree. Okay. So let's talk about the different uses of a reverse mortgage. First, and probably the most common, is to refinance your current mortgage to eliminate your current principal and interest payment. So let's say, because of inflation, your monthly budget is getting tight, and you're paying $2,000 a month on a mortgage. You can refinance that mortgage and eliminate that payment. So now you have $2,000 more a month to live on. Or you could obtain a lump sum in cash. So you can get a reverse mortgage and just get the proceeds from the loan. Maybe your home is free and clear. You can get paid a lump sum. Now they do it in 2 tranches. One when you close on the loan, and then one 12 months later. And they do that to help from people committing fraud. So it actually takes 12 months to get the full lump sum. Or you could set up a monthly stipend, like an income, to be paid to the borrower to supplement monthly retirement income. So basically, you could have the home paying you, and it comes every single month, same amount every single month. You could use a reverse mortgage to set up a line of credit. So let's say you really don't need any money, but you don't have a lot of assets to lean on if something unexpected happen. You get injured, you have to go into assisted living, you need home improvement. So you can set up a line of credit that you draw from at any time you want, and you can use it for anything you want. You could use it for home improvement, again, medical treatments, travel. It doesn't matter. You can actually go buy a second home with it if you wanted to. You could use reverse mortgage to purchase a nicer home or to purchase a smaller home, downsize. So we're going to go through an example like that of, there are a lot of people that think, oh, I can't move to Hawaii and live in Hawaii. My home on the mainland, it's free and clear. It's $600,000. But I can't buy anything in Hawaii for $600,000. And I'm retired, so I can't qualify for any loan. Well, a reverse mortgage can solve that problem. You can sell your home on the mainland, take the $600,000, come to Hawaii and buy $1 million home. And still have no mortgage that you have to worry about. So it's a nice vehicle. You can actually use the reverse mortgage, and some people have done this, that were being foreclosed on. And we can use a reverse mortgage to pay off the current mortgage, and you get to stay in your home and avoid foreclosure. So, that's another nice feature of a reverse mortgage. Mainly, we're trying to enhance I'm sorry. The reverse mortgage can also be used to enhance the performance of your retirement investments. So for example, let's say you own stocks and you're selling off $10,000 a month to live on. Every month you sell $10,000 of your stocks. But let's say the stocks are right now, they're going up like crazy, and selling them doesn't make a lot of sense. So instead, you could have had a line of credit from your reverse mortgage, and instead of selling off those stocks at exactly the wrong time, you could draw off your line of credit from your reverse mortgage, live on that while your investment accounts are performing. And then at some later date, when things slow down a little bit, you can sell off some stock and pay down or pay off the line of credit on the reverse mortgage. So you can be pretty rich and still use a reverse mortgage in a way to enhance your retirement investments. And then finally, a reverse mortgage can combine many of the uses above into one loan. So you can pay off your current mortgage, set up a monthly stipend that you get paid monthly, and have a remaining line of credit that you can use at any time. So these mortgages get a little complicated, but they can have many things. Again, you can pay off a current mortgage, set up a monthly income that gets paid to you every month, and have a remaining line of credit for any unexpected expenses. So it can have all of those features all into one mortgage. So it is pretty amazing financial tool. Okay. Any questions so far? All right. If you do, just what's that?
Yeah, may I have a question?
Yeah, go ahead.
Okay. Yeah, basically it's a loan. My understanding is that.
Yes, it is a loan.
So, how about the tax return? The income?
Good question. So because you are consuming your own equity, there is no tax implication. There is no, you're going to get this money, but it's basically your money as if it were in a savings account. They don't tax you when you withdraw money from your savings account, and you don't get taxed when you're withdrawing equity from your home. So there is no tax implication. Now, you do not get to write off the interest that's accruing on the loan because you're not paying it unless you did pay it. So let's say for some reason you did decide to pay down the mortgage. If you did pay down the mortgage, the interest that you paid would then be tax deductible, but it's not if you don't pay it. Okay? That was a great question because, again, you can receive an income from your mortgage and it's tax-free. So,
okay.
Okay. So
Kurt, I have a question.
Yeah.
So say if somebody wants to do a reverse mortgage on their house and then buy a house, like say maybe they're in Kentucky and they want to get a reverse mortgage, buy a house in Hawaii. They're going to have insurance. So like in Hawaii, they would have to have hurricane insurance, and the hurricane insurance and everything is so expensive. So I'm curious how it works to, like, for some of these people, like you say, want to move to Hawaii or that want to get out of Hawaii and move someplace else to use a reverse mortgage to get the cash to buy the other house.
Yeah. So, I mean, there's two scenarios here. You could get a reverse mortgage on your current residence and buy a second home, a vacation home. But that vacation home, you're going to have to qualify for under normal loan requirements showing income and assets and things like that. So that's a little harder, but if you have significant retirement income, you could use a reverse mortgage for the down payment on a second home or a vacation home. But if you are wanting either to buy a home in Hawaii and move here, or you're in Hawaii and you want to move to the mainland where it's a little less expensive, you first have to sell the property that you're in and use those funds as the down payment on a new home where we use a reverse mortgage to acquire that property. So let's say, for example, you're in Hawaii and you want to sell your home and you're retired and you have no income. A lot of people think that they're stuck. If I sell my home, I'm not going to get a loan on the mainland because I don't have any income. But that's not the case with a reverse mortgage. If you've got a big enough down payment, you can take the proceeds from the sale of a home here in Hawaii and then go to the mainland, put enough of a down payment down, and you don't have to use all the money. You can use only a portion of it, but enough to get the reverse mortgage. And then you can acquire the home, and it goes both ways, whether you're selling on the mainland and coming here or selling here and going to the mainland. And then you can use reverse mortgage to acquire a new property. And the beauty of that is you don't have to show any income. Now, when I say you don't have to show anything, we still have to go through an analysis that shows that you have enough either assets or Social Security or whatever to make the property taxes, property insurance, any HOA dues, and you have enough money to live on for food and utilities. So we do a budget to make sure that once you're done, all said and done with your reverse mortgage, that all your other living expenses can be satisfied. And that's one thing that we do during the process.
So say if somebody wants to sell their house in Hawaii, and they don't tell you they have a reverse mortgage on it, how do you find, the prelim will show it.
Well, it doesn't matter if you have a reverse mortgage. It's just like any other mortgage. When you sell a property, that mortgage has to be paid off. So if you're selling a property in Hawaii and that property has a reverse mortgage, it has to be paid off. And you get the difference, just like any other mortgage. So, anytime you sell a home, if there's a lien on that home, it has to be paid, and you get the difference of what you sell it for and what the loan balance is. And that's identical to a reverse mortgage. So there's no difference in how that transaction, nobody would really care if it was a reverse mortgage on the property. It didn't mean anything to the transaction. Okay. Good questions. Okay, so the basics of a reverse mortgage, again, you have to be 65. You have to be a U.S. citizen or a legal permanent resident alien. I shortened that. You must live in the property as a primary residence at least 6 months and 1 day a year. So you could winter in Hawaii and summer in Minnesota, whatever. You must receive independent counseling, and this is it's just a 1 hour course. You're basically going to get everything that I'm telling you here from an independent counselor. And they do that to make sure that your loan officer isn't filling you full of false information to get you into the reverse mortgage. They're going to get an independent person to make sure that you're getting all the information as accurately as possible. And again, the amount that you get is based on your age, your current interest rate, your property value, and how nice you treat your loan officer. So, no. I'm kidding about the fourth one, but nobody laughed. Everybody's got their speakers off. It's just the top three. Even if you don't treat me nice, you still get a certain value based on that. Okay. So let's talk about the loan process. The very first thing you have to do to get a reverse mortgage is you have to go through counseling. You can't even make an application for a reverse mortgage until you've completed the counseling, and I can help you get set up with counseling. The application is just a normal everyday application. You apply for the HECM loan, and you provide us with a signed and dated counseling certificate. We do ask for, we make you fill out a form to go over your living expenses, what your property taxes are, your property insurance, HOA dues, and we then compare that to your retirement income and other assets to make sure that you either have the monthly income or you have the assets to maintain your life without the mortgage, so. And that's especially important if you're using a reverse mortgage for trying to avoid foreclosure. And, it's a really good loan for people in foreclosure because normally you wouldn't qualify for a loan if you were in foreclosure. So you can avoid that. And then during processing, we get an appraisal, we process a loan, get it approved, just very similar to any other mortgage process. And then we close, and it usually from start to finish, it's a 45-day process. Okay.
Kurt, what's the maximum you can get on a reverse mortgage? I heard it was only $1 million. That was the max.
No. So let me explain a couple of things. On a HECM loan, the FHA loan, they cap your property value at $1,238,500. So that's the conforming loan limit. So normally you can only borrow about half of that. So you're going to be limited to $600 and some odd $1,000. Depends on your age. If you're 90 years old, you get a lot. But then we switch to what we call proprietary reverse mortgages that go to $4 million. And at least that's the highest I've ever heard, up to $4 million. And those loans are a little less sophisticated. You get one loan. You don't get all of these other options like monthly payments and lines of credit. It's just one lump sum loan. You can put any money that you're not using into an investment account or something like that. But you can go to $4 million, but that means your property would have to be worth like $8 million. So, but you can go above. There are jumbo HECM loans. I've done one. I think we went 3.3 million on a reverse mortgage. So you can go pretty high. Okay.
So it's generally half of what the appraisal is.
No, it's depending on your age and the interest rate at the time. So as interest rates go down, the percent you get goes up, and so we're starting to see that happen, where if you were a certain age, you will get more. I mean, if you try to get a HECM loan at 62, you're going to get less than an 85-year-old person, right? Yeah. And so it's very specific to you, and we can run the numbers for you, but you're not going to normally get more than 50% because the lender has to leave room to pay the mortgage while you live in the home. And if you're going to live in the home for 20 or 30 years, that interest accumulation is going to be about half the value of the home. But what's interesting, and I'm not going to get into this gets really complicated really quick, but they assume that your home is going to increase in value every year. And normally I see the value of the home increasing almost as fast as the interest that is accruing on the loan. So if you started with $500,000 in equity in your home, you're probably going to have that $500,000 in equity almost through the duration of the loan. And what's nice about the HECM loan is that you're left with a line of credit. Now, maybe in the first year, it's not very much, but every year that line of credit goes up. So, for example, I just did a loan with a client that their line of credit was going to go up $40,000 a year. So at the very beginning, they didn't have much of a line of credit. They paid off their current mortgage, and I think they were left with $35,000 in a line of credit, but every year it went up $40,000. So they could depend on, and that's fixed from the very beginning. No matter what happens to the market, it's going to go up every year, that line of credit. So they were saying, well, geez, that's that's like $3,000 a month I can count on after the first year, and it's going to go up every year after that. So that's another nice benefit. So again, it gets a little complicated, but it's a hell of a program. I mean, it's got a lot of facets to it. Now, on the jumbo loans, they don't do it that way. You just get one big payment, and you'll have to take the money and put it into an investment account if there's excess money that you're getting that you don't
And
have any use.
there's no taxes on that.
That is correct, because it's your equity. You don't pay tax on your own equity. Yeah. It's kind of like a home equity line of credit. If you take money out on a home equity line of credit, you don't pay tax on that. Okay, so let's go through scenario one. If I've got John and Jane Smith, let's say they're 85 years old. They want to move to Hawaii to be closer to their grandchildren. They sell their home that is free and clear in California for $600,000. They come to Kona and buy $1 million home, which would probably be about the same size as the California home. They make a down payment of $561,000. They get a reverse mortgage of $439,000. And they're in the exact same situation that they were in California. They have no mortgage payment, and they're living in Kona with a much more expensive home. And they don't have to pay any mortgage for the rest of their life. And what's interesting about Hawaii, and most of you know this, is that if you're a resident and it's your primary resident, taxes here are a lot lower than most of the rest of the United States. California is 1%. We're just under 0.6%. So we're more than 40% lower in property tax in Hawaii than California. So that's another benefit,
Hey, Kurt, can I pause you
yeah.
a second? We
Yeah,
did
go
have
ahead.
one question that came in right as the
Okay.
slide changed, asking if we discussed appraised value and if the property can be rented for part of the year and what's the max number of days annually.
Oh, those are these are good questions. Okay. So, everything is based on the appraised value of the property. So we do get an appraisal, and that's going to dictate what loan amount you're going to get. And I've had some bad appraisals, and we've argued them and gone out and got another one. So, but appraised value is the starting point of how we make the calculation of what you're going to get. And yes, you can rent your property. You can rent it while you're living in it. You can have a boarder. If you had an ohana, you can rent the ohana. Now, you do have to pay tax on that. So that's a taxable income. And if you leave, let's say you're a snowbird and you spend 6 months and 1 day in Hawaii and you rent it out for 5 months and 29 days, as long as you are in the home 6 months and 1 day, but you could actually have a permanent renter in the home 12 months a year, as long as you're in the home as a primary residence 6 months and 1 day. And every year you have to get a certificate of occupancy to show that you are living in the home, and they can do things like request a driver's license and a tax return to show that you're still paying taxes in Hawaii and so on and so forth. So they do keep track of this. So good question. Okay. So let's look at so on scenario one, if there's any realtors that are on the phone or on the call, it's important that you understand the purchase reverse mortgage, because if you understand the reverse mortgage purchase process, you can really benefit from it, because there's many retirees that don't know that they can qualify to purchase a new home because they don't have an income. They kind of feel stuck. And retirees are choosing to maintain a better lifestyle in a home that better fits their needs. So they might go from a 2-story home to a 1-story home. And this does open up as we're heading into the baby boomers are doing a lot of things right now. They're downsizing. You can upsize. They're moving closer to their grandchildren, but it's a big market for new clients. So, I've talked to clients that were on island that said, well, yeah, I'd love to live here, but I won't qualify for anything, And so you don't need to qualify for anything. And you go through their scenario, and sure enough, they've got enough equity in their home to sell their home wherever they are and move here. So, they can upsize, downsize. It's a very mobile market if they don't have to qualify using their income, because they may not have any retirement income except for maybe Social Security, and that might not be enough to buy anything. So it can help you increase listings and produce more sales. So for realtors, this is important to really understand this process. Okay, so I'm going to go to scenario 2. And this is about monthly income. Again, we have John and Jane Smith. They're 85 years old. Their home is free and clear, maybe worth $1 million. They can obtain a reverse mortgage and receive $3,300 or $3,350 per month for life. Or let's say, they just want 10 years of income, because at 95, they're going to move close to their family because they're going to be getting too old to live in their house. They receive $6,000 per month for 10 years. And remember, there's a line of credit that's sitting back in the background. Maybe it starts with nothing, but it'll start accumulating value over time. Could be $40,000 a year. And, so over 5 or 10 years, you could have $200,000 to $400,000 of additional line of credit. So it's a pretty crazy program. But look at that. A lot of people could really enhance their retirement income. Several $1,000s a month would make a big difference to a lot of people. And with the inflation that we had over the last number of years, I know a lot of people that have gotten pinched in their retirement budgets, and they've come to me to relieve that problem, and we've done that. Okay, let's look at another one. So this is a line of credit and a lump sum payment. So again, John and Jane Smith, their home is free and clear. They obtain a reverse mortgage. Now they've got a line of credit of $439,000, or maybe they want to improve their home or something. They can put $250,000 into the bank and still have a line of credit of $188,000. And that line of credit is going to go up every year. So again, there's so many options for you to choose from. And what I tell most of my clients, if you are looking at a reverse mortgage and interest rates go down over the next 3 or 4 years, which, I hope they do, you might be refinancing in 3 or 4 years, because you can get a lot more money if the rates go down, and you're that much older. And, again, your age, the older you are, the more you get. So that's another facet. Okay. So some common misconceptions about reverse mortgages. Certainly, the home doesn't have to be debt-free before you can borrow. And frankly, most reverse mortgages are actually to pay off a current mortgage so that you don't have a monthly payment. Another misconception is that your bank owns your home and will take possession upon your passing. That is not correct. You retain title to your property just like you would with any other home. Upon your passing, your heirs get the title, or as long as you name them, and they can either pay off the reverse mortgage or sell the home, and they get the proceeds of anything over and above the amount of the loan. Also, you and your heirs are not. A lot of people think that the heirs will be personally liable for that loan after passing, and that's not true at all. In fact, the reverse mortgage is one of the only non-recourse loans available that I know of. It's non-recourse to you, and it's non-recourse to your heirs. So, for example, if you pass and the home is gone down in value and the mortgage is more than what you owe, and let's say you have other assets, you've got savings and a 401k, or you could have other property, that the lender cannot come after you for any money. It is non-recourse. They can only look to the property to get paid. If they don't get paid 100%, the insurance kicks in, and the insurance makes the payment to the lender for the difference. Okay? And this is the most common misconception: is your heirs will receive nothing, even if the home is worth more than the mortgage balance upon your passing, and that's just not true. They get anything over and above the mortgage balance and any closing costs. But so if there's equity in the home when you pass, then the estate gets the difference. Okay, just like, again, any other mortgage.
Kurt, can you discuss the fees and closing costs associated?
Yep. I've got a slide for that, so we'll get to that in a minute. And there's no free lunch. This sounds all too good to be true, but there's some expenses into this. So with FHA and the HECM process, there are some protections that are important. One, you get independent counseling, so you get another view from another person of how all this works. It is insured by the FHA. So what if the lender goes out of business and they stop making your monthly payment? Well, the FHA steps in and continues making your payment. So if you were getting a stipend, you'll still get it, even if the lender goes out of business. We do complete a financial assessment to make sure that once you have a reverse mortgage, that you're financially stable and you can, live reasonably well with what you have in retirement income and assets. There are non-borrowing spouse rules. So let's say there's a married couple and one person is much older than the other person. You can leave the younger spouse off the loan to get more. And then upon the passing of the borrower, the non-borrowing spouse has a certain amount of time to decide what they're going to do. Either they sell the home, pay off the reverse mortgage, or get a normal mortgage to pay off the reverse mortgage. So the non-borrowing spouse does have some protections about how long they have to deal with the home.
And
Remember, yeah.
Oh, sorry. Is there interest payment on the line of credit when you use it?
No, it's just the same rules as the reverse mortgage in itself. Is if you have a line of credit and you draw from that line of credit, any interest that accrues during the month just gets added to the principal balance of the entire loan. So it's only one loan, and make sure you understand that it's just one loan. How you draw money and how interest is accrued will depend on, well, you got a line of credit or you're getting a monthly stipend. So as you, and if you can believe this, you can even get a reverse mortgage in a second position behind your current mortgage. Now those are really new, and it's, I haven't done one of those before, but learned how to do all that. Oh, about the interest, yeah. So you don't pay any interest on the home equity line of credit. It'll just increase the balance on the loan as you draw from the home equity line of credit. And again, the home equity line of credit limit goes up every year. Okay. I did mention that the loan is non-recourse, so they can never come after your estate or your heirs for any shortfall. There is no prepayment penalty. And, there are some pretty wealthy people that'll use a reverse mortgage where they'll live on the reverse mortgage for a while. Then they find an opening in the market. Well, they're going to sell some stock, pay down the reverse mortgage, and maybe to zero even, and then use it again later. So it can be, you can, pay it off, and you don't have to close it. If you pay off the balance, it's still there. Now, there are situations where we look at your history, and let's say you haven't had a good history of paying your taxes or insurance. Sometimes the lender will require you to set money aside, and it's called a life expectancy set aside, so that when taxes come due and insurance comes due, it gets paid. That's only in a situation where you haven't shown a good history of maintaining payments on property taxes and insurance. Okay. And as long as you maintain your properties, property tax, property insurance, HOA dues, and maintenance, you have the right to stay in your home for life. So you can never be asked to leave, no matter what the balance ends up being. We could have a big, home crisis where values drop by 50% like they did in 2008, and you're still protected. Okay. All right. We're getting down to the end of this. So again, the benefits to the borrower, it gives the homeowner access to a portion of their equity with no income qualification and to improve your retirement. It requires no payments until the last borrower leaves the home or passes. It's non-recourse, we just said that. And the borrower does retain title at all times. So you can do anything you want with that home. You can sell it, move to a different one, just got to pay off the mortgage, just like you would with any other mortgage. Eligibility, there's both property eligibility and borrower eligibility. I think we've been through the borrower, 65, 62 years or older, U.S. citizen or legal permanent resident alien. You must occupy the property as your primary residence and stay in it for 6 months and 1 day. You must receive counseling. You must pay the property taxes, property insurance, and HOA dues, and maintain the property. You can buy any new or existing single-family home as long as it's in good repair. You can't buy a home that has safety issues or there's health issues like mold or anything like that. Now, here's an interesting one. You can use a reverse mortgage to buy a 2-unit, like a townhome, a triplex, or a fourplex. So you could buy a fourplex, live in one of them, rent the other 3, and not have a mortgage payment and getting income from the other units. It was kind of like that question, can I rent part of my home out or an ohana or when I'm not there? Absolutely. You can generate quite a bit of income. And there are a lot of retirees that will go buy a fourplex. They've got all the income coming in from the other 3 units and they have no mortgage payment. So that's pretty cool. On condominiums, it either has to be an approved FHA project or we have to go in for a single unit approval. That's pretty easy to do. We're real familiar with most condos in Hawaii and which ones will qualify and which ones don't. And you can buy a manufactured home as long as it meets the FHA standards. So you can pretty much buy anything except for condo hotels, condos that are in litigation or something, some problem condo you wouldn't be able to buy. Okay.
And then Kurt,
yeah.
how do you know if a house has mold? Mold is everywhere in Hawaii.
Oh, that's true. I go into my closet sometimes and my shoes are moldy. So now we're talking about real serious problems where the home is deemed a hazard, and we've seen those where the railing, you go up and shake the railing on a balcony and it is ready to collapse, or there's holes on the deck out on a balcony deck or something like that, or there's serious mold, black mold, where an appraiser is going to report, hey, this is not livable. And it gets down to the appraiser. If the appraiser says it's not livable, it's not livable. And it would have to be repaired before you buy the home. So, yeah. So on repayment, the loan does not need to be repaid until the last borrower leaves the home or passes. The loan can be repaid through the sale of the property or the sale of other assets, such as, and this is an important one, you can get a reverse mortgage and then obtain a life insurance policy that will pay off that mortgage upon your death so that your heirs get 100% of the property. And there's, that's another nice financial vehicle, depending on your age and how expensive it is, but you can acquire a life insurance policy, pay off the reverse mortgage. Any debt that would be remaining is not passed on. So there's no personal liability on these mortgages, which is different from a regular mortgage. If you're upside down on a regular mortgage, you're responsible for the difference. Once the loan is repaid, the remaining equity goes to the homeowner or their heirs. And if you pass away, your family members can purchase the property at 95% of its appraised value. The only time that would really come into play is if there weren't, if you didn't have a, you hadn't named them as the heirs to the property or something like that, but they could buy it at 95% of the appraised value. So there's a little bit of benefit there. So is the reverse mortgage interest rate comparable to conventional mortgage rates, or is it higher? That's a good question. If it's a you can have the same thing on a reverse mortgage as you do with a regular mortgage. You can do a variable rate reverse mortgage or a fixed rate reverse mortgage. The fixed rate is higher than the current fixed rates on conventional loans, but the variable rate loan is about the same. I think I did an analysis on one recently, and the rate was going to be 5.95%. And I like the variable rate loan because we think there's a pretty good chance that rates will go down a little bit more, and you would benefit from that. So again, it depends on what loan you choose. Listen, if you're getting a reverse mortgage and you really don't really care about the loan itself, that when you pass, you pass, and you're not horribly concerned about giving a lot to your heirs, the variable rate loan is probably better because the rate is always lower than the fixed rate. Now it could go up, obviously, but if you don't have to pay off the loan and you're not making payments, it really doesn't have any effect on you during your life. It has an effect if you pass and when you look at your estate. So, but I kind of like the variable rate loan, and they use the constant maturity treasury. So that's what I would recommend using for most people. Yeah. Okay.
There was a follow-up question. How much higher is the
Oh,
rate?
yeah. So I was looking at a loan. So fixed rate loans are in the sixes. I think the fixed rate reverse was in the high sixes, maybe low sevens. Again, it's a loan that has no length of time. So that's the reason the fixed rate is so much higher, because it could last for 40 years. And that's the reason it's a little bit higher. I normally recommend the variable rate loan. Yeah. And some years it might be a little higher, some years it'll be lower. So, but if rates do go down, you'll probably be refinancing it anyway in 4 or 5 years. So, and again, it's kind of based on your situation, what fits you the best. Okay, so we had a question of how much does it cost, and so it is more costly. There's no free lunch. So just so you know, most of the closing costs are financed, usually are all financed by end of the loan. So there is mortgage insurance that the lender gets, and it's 2% of the home value up to $1,238,500. So if your home's worth more than that, it caps out at that. So that's the biggest component. And then the loan origination fee, which goes to me, is capped at $6,000. That's much lower than we normally get paid. So on one hand, you have the upfront mortgage insurance premium, which is expensive. And the reason for that is if the home ever goes upside down, the lender gets compensated for the difference. And all the other closing costs are standard, appraisal, escrow, title. And again, all of the closing costs are usually paid through, through the loan itself. So you're not coming out of pocket. But the big number is that upfront mortgage insurance premium. And there are a lot of loans that I do for, like first-time home buyers that have mortgage insurance premiums. They're not 2%, they're usually 1% or less. But this program, that's the big sticking point, is that mortgage insurance premium. And you can refinance a reverse mortgage, and it will most likely happen if rates go down. So again, you might look 3 years from now and say, wow, the fixed, I'm in a variable rate loan and I've done really well with that, but now I can get a fixed rate at a pretty good rate. I'm going to refinance. And because the rates are lower and you're older, you can get a lot more money. So again, this may not be the last loan you ever have. So even if you stay in your home for a long time, if the market conditions cooperate, you may end up refinancing it. And it's just, you go through the process again. Okay, so that's kind of your retirement, your way. I did talk about financial security and retirement planning. You can use a reverse mortgage to keep from selling your stocks, which you might have to even pay tax on those stocks or IRA distributions. And you can time the sale of your investment accounts better using a reverse mortgage. You can use a reverse mortgage to enjoy your retirement, learn new hobbies, spend some money on woodworking tools or whatever. But, it really is important. The whole reason for a reverse mortgage is to improve your retirement. You can travel. You can use that money to do anything you want to do. Travel, buy a second home. And you can use it to, protect yourself from, rising living expenses, or maybe you need health care. Maybe you need somebody to come in and visit with you every day for an hour or so. You can do home modifications. So again, this is all about you and your retirement. Okay, I think that is it. I think I'm right at 1 hour, which is usually where we end. If there's, you can open it up and unmute, and if you have any other questions for me. And we did tape this, so we will post this to YouTube, and it's just youtube.com/@eMortgage Hawaii with no spaces. So eMortgage Hawaii, you can go to YouTube, and we have a lot of other seminars that we've taped over the past, and we'll be doing more coming up. So that will be available to you on YouTube. Okay, any other questions?
Thank you.
Okay, go ahead. Just unmute.
I think they were just saying thank you.
Oh, great. Okay. All right. Well, go to our YouTube channel. There's some other videos that we've done on first-time home buyers and making money through real estate and bridge loans and DSCR loans and things like that. So, okay,
Kurt,
everybody.
if I could just ask you a question. If we have a specific scenario, what is the best email address that we can reach you at?
Oh, good. It's real simple. It's just Kurt, K-U-R-T. Or you can send to Alex, A-L-I-X, at eMortgageHI.com. So the letter E is in Edward, mortgage, FHI.com. Or just call.
Okay, great.
My
Thank you very
my
much.
number. All right.
And I threw it in the chat there too, Anthony, if you need it.
There we go.
Okay, great. Perfect. Thank you.
All right. Thanks for attending, everybody, and have a great
Oh.
rest of your weekend.
Kurt, we have one more question.
Oh, good. All right.
If I purchase a second home with proceeds from a reverse mortgage and decide to move into the new home, can I get a new reverse mortgage to pay off the old home?
Well, yeah, that's you can absolutely. So you would have 6 months if you move it out of the home that has the reverse mortgage. You have 6 months to pay it off. So during that 6 months, you could get a new reverse mortgage and pay off the old reverse mortgage. Absolutely. These are great questions. A lot of dexterity with these reverse mortgages. It's got so many facets, and I'm amazed they're not more popular. But okay, I'm going to let everybody go unless there's any other questions. Okay,
All right, looks like we're good.
thanks a lot. Have a great weekend, everybody.